Welcome to the Deep Dive. Today we're getting into IAS 16. That's the standard for property, plant, and equipment.
That's right. Think, the big tangible things companies own and use. Factories, machines, office buildings, stuff they plan to use for more than just 1 year.
Exactly. And our goal here is to really unpack how companies account for these assets. It's pretty fundamental for reading financial statements, wouldn't you say?
Absolutely fundamental. IAS 16 gives users information about, how much a company has invested in these assets and how that investment changes over time.
So it covers the big questions. When do you actually record an asset? How much is it worth initially? And how do you account for it as it gets used up or its value changes?
Precisely. And it deals with depreciation and impairment, too. It's interesting. The standard's been around since '93, but it's seen tweaks. Like they clarified you can't base depreciation on revenue in 2014.
Oh, right. And added bearer plants. With fruit trees.
Yeah, those got included too, treated like self-constructed assets. And there were updates in 2020 about proceeds before an asset is ready for use.
Okay, let's start at the beginning then. Recognition. When does, say, a new delivery truck actually make it onto the company's books as pp&e?
Two key tests need to be met. First, it has to be probable, likely, that future economic benefits will flow to the company from that truck.
Okay, so it needs to help make money somehow.
Basically, yes.
Yeah.
And second, its cost has to be measurable reliably. You need a solid number.
And that cost, it's not just the purchase price, is it?
No, definitely not. It includes the purchase price, sure, but also any cost directly needed to get that truck ready and in the right location for use.
Like what kind of costs?
Well, think delivery fees, installation if needed, maybe initial testing costs, even things like site preparation or professional fees directly related. And importantly, the first estimate of costs for dismantling and removing it later, and restoring the site if required.
Okay, that's quite comprehensive. What about costs later on, like routine servicing versus a major engine overhaul?
Good question. Day-to-day servicing, like oil changes, that's usually just an expense in the period it happens, recorded in profit or loss. Right.
But if you incur costs replacing a major part, like that engine overhaul, or doing a major inspection required to keep operating it, if those costs meet the main recognition criteria.
Probable future benefits and reliable costs.
Exactly. Then you can capitalize those costs, add them to the truck's carrying amount, but you also have to de-recognize, remove the carrying amount of the part that was replaced.
Got it. What about that 2020 amendment, items produced while getting ready?
Yes. If, say, you're testing a new machine and it produces some items you can sell before it's ready for its main intended use.
Okay.
The proceeds from selling those items and the costs of producing them are now recognized directly in profit or loss. They don't adjust the cost of the asset itself anymore.
Interesting change. Okay, so the asset's on the books. How do we measure its value after that initial point?
Two choices here, the cost model or the revaluation model.
Most companies use the cost model, right?
That's generally true, yes. It's simpler. Just cost less accumulated depreciation and any accumulated impairment losses. Keep it straightforward. And the other one, revaluation.
The revaluation model. Here, the asset is carried at fair value at the date of revaluation, less any subsequent accumulated depreciation and impairment. But fair value has to be reliably measurable.
And you can't just pick and choose which assets.
No, if you revalue, you have to do it for the entire class of assets. That item belongs to all your buildings or all your machinery. And revaluations need to be kept up to date regularly.
What if the value goes up? Does that boost profits?
Not directly into profit or loss, usually. An increase goes to other comprehensive income and builds up in equity under a heading like revaluation surpluses.
Okay, so it affects the balance sheet equity. What if the value drops?
A decrease usually does hit profit or loss, unless it's reversing a previous surplus for that same asset that's sitting in equity, then it reduces that surplus first.
Right. That makes sense. Let's talk depreciation. This is about spreading the cost, isn't it?
Exactly. It's the systematic allocation of the depreciable amount that's cost minus residual value over the asset's useful life.
And you mentioned significant parts.
Yeah, if an asset has major components with different useful lives, you should really depreciate each part separately. Think of an airplane, the engine, the fuselage, the seats might all wear out differently.
Okay. And the useful life or residual value, those aren't set in stone.
No, definitely not. Companies need to review those estimates at least every financial year end. If expectations change, you adjust the depreciation for the current and future periods. It's a change in accounting estimate.
And depreciation happens even if the asset's market value is actually higher than what's on the books.
Yes. Depreciation reflects consumption of the asset's service potential, not necessarily changes in market value. So depreciation continues. It starts when the asset is available for use and stops when it's derecognized or classified as held for sale.
What kind of things determine that useful life?
Several factors. Expected usage, physical wear and tear, technical or commercial obsolescence like new technology making it outdated, and even legal limits like the end of a lease term.
And how do you calculate the depreciation charge each year?
The method should reflect the pattern in which the asset's future economic benefits are expected to be consumed. Common ones are straight line.
Spreading it evenly.
Right. Or diminishing balance, where it's higher depreciation earlier on. Or the units of production method, based on actual usage or output.
But not based on revenue it generates.
Correct. That 2014 amendment explicitly prohibits revenue-based methods because revenue reflects more than just the consumption of the asset itself.
Okay, final step. Derecognition. When does an asset come off the books?
Two main triggers. Either on disposal you sell it or scrap it, or when no future economic benefits are expected from its use or disposal. Simple as that.
And any profit or loss from selling it.
That gain or loss, the difference between the disposal proceeds and the carrying amount, is recognized directly in profit or loss for the period.
So wrapping this up, really understanding IAS 16 is crucial for anyone looking at a company's financials, wouldn't you agree? It touches these core, often very valuable assets.
Absolutely. It provides that consistent framework. It lets you compare companies, see how they're investing, how they're managing these long-term resources. It's about transparency.
Right, giving you a clearer picture. So a final thought for you, the listener. Consider how a company's choice of depreciation method or deciding whether to use the revaluation model could shape the financial performance they report. What might those choices signal about their strategy for managing these vital assets over the long run? Something to think about. That's our deep dive for today.
Until next time.
Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.